Thirdly, we have unemployment insurance. Unemployment benefits that replace a portion of the lost income can be provided to cover unpredictable and unmanageable events. Such losses can occur for many reasons. Most can be categorized into either temporary events that affect small groups of people or permanent technological or demographic changes, which may have a significant impact on the employment rate of the country. Unemployment insurance bears many similarities to disability insurance, not least because it is those who are least fit who are most at risk of retrenchment. Fourthly is medical costs insurance. Medical cover comes in a variety of forms and is normally intended to supplement whatever medical services are provided by the state. We have medical insurance, which covers of indemnity to the life insured for the medical expenses incurred by his or her immediate family. The cover may be for all medicines, consultations, procedures and hospital visits. There may be maximum annual limits to the overall claims, or claims in each category. There may also be deductibles. Secondly, we have critical illness insurance. These are not indemnity contracts but pay out a predetermined amount in the event of the diagnosis. These policies are less expensive to administer than more comprehensive medical cover, as they only pay for the larger costs. Next, we have hospital cash, which is the simplest form of medical cover, paying a fixed amount for each day the insured spends in hospital. These contracts fulfill a need to the extent that the more significant medical costs are related to stays in hospital. Furthermore, life insurance also have health maintenance organizations. Medical expenses are fully covered. These is no incentive for the two parties to reduce costs. The healthcare professionals are paid a capitation amount for each person covered. Lastly is long-term care insurance that covers the costs of assistance with the needs of everyday living. The cover is expensive and not easy to contemplate at a young age. Lastly, we have general insurance. This is called property and casualty insurance in North America and can also be called short-term insurance because the contracts are reviewed annually. General insurance policies are indemnity contracts. The actual claim amount may be smaller than the sum insured. There are 4 types of general insurance. The first one is home insurance, that includes homeowners and householders insurance. They cover the house or apartment itself and its contents respectively. More valuable personal items such as jewelry may need to be covered separately and present more difficult moral hazards. Next, we have motor. This can cover loss or damage to the policyholder's car and any damage to the person or the car of any third party. Compulsory third-party insurance to cover death, disability and medical insurance is commonly required by governments. In some countries, CTP insurance is subcontracted to private companies. In others, the costs are included in the price of fuel, on the basis that a driver's risk is related to the distance driven. Next, we have personal accidents. This is strictly life or disability cover, but limited to losses caused by accident. Short-term insurers can offer it because the risks do not generally increase with age. It may, however, be difficult to integrate with insurance for other causes, leaving people with insurance gaps or excessive entitlements for benefits arising from the accident. Lastly, we have business insurance that covers common type of insurance bought by businesses. For example, marine insurance, fire and other property cover, and credit insurance. The purpose of long-term savings is to secure a comfortable retirement. First, traditional life insurance savings products generally pay a sum insured at the end of the policy term or on the earlier death of the insured. These products share in the distribution of profits or allocated largely at the discretion of the company. The usual mechanism is to add bonuses to the sum insured. They are permanent additions to the sum insured, or they only vest in the policy owner on the termination of the contract. It paid in cash and used to reduce the premiums. The main forms of traditional savings policies are endowment insurances, pure endowments and deferred annuities. Endowment insurances pay the sum insured on death or on survival to the end of the policy term. Next, pure endowments pay the sum insured on survival to the end of a fixed term and usually give a return of premiums with interest on earlier death, and deferred annuities pay an annuity when the annuitant reaches a predetermined age. Superannuation funds, also called as pension or provident funds. Superannuation funds are vehicles established for the purpose of providing lump sums or pensions retirement. They are very common and reflects the continued growth in living standards, the increased length of healthy retirement and the tendency to treat superannuation contributions made by the employer as deferred pay.